Okay, so we'll give it another 2 minutes because only so far only 6 of you have joined. That's my name, Deepesh. Okay, right. So we'll give it 2 more minutes before we start. What was covered in the last class? Not last weekend, the last class, last topic, or rather.
Now it's collateral management and security lending and borrowing.
Okay. Any questions or doubts from that before we go on to asset management today? No? Okay. How many people in this batch? We got around 12 I see right now. Is that the number that is there normally? Guys, how many people are there in this batch? Approximately. Okay. So I'm gonna share my screen. So today's topic is gonna be asset management, and tomorrow we have a overall refresher. So I'll be conducting the session again tomorrow. So please go through your level 2 notes tomorrow, and what all doubts you have, we'll clear that tomorrow. Is that okay? Guys, can you hear me? Because on chat I don't hear anything, or no one saying anything on the audio. Can you hear me now? Okay. So I'm going to share my screen and we're going to start the topic today. So, what is asset management? What is asset management? You can let me know on chat or you can unmute yourself and let me know. What is asset management, folks? A rough guess, anything. Okay, investment on behalf of others, managing clients' funds and investments. Okay, that's correct. So, asset management, let me see. Asset management refers to management of investments on behalf of others. Okay. Investments that refers to as equity, fixed income, bonds, your hedge funds, mutual funds, commodities, derivatives, your currencies or FX market, real estate, etc. That is what is referred to as asset management. The aim of asset management, or usually asset managers or asset management companies, is one, appreciation of the client's assets and mitigate any risks. Okay. So asset manager is, or asset management is usually done by an AMC, which is short for asset management companies. Your clients to AMCs are your HNIs, government entities, corporations. It can be institutions as well. Okay. Or it can be even your hedge funds and mutual funds. Is it clear till here? Yeah, so write this down before we continue. Done? Done writing, guys. Can I move to the next step? Okay. So we're going to talk about mutual funds. What are mutual funds? What are mutual funds? You must have heard of this term mutual fund, right? Pooled investments. Yes, thanks, Anand. Safe investment for returns. Yeah, Diktesh. Anyone else? Oh, sorry. I didn't realize I was on mute. Right. So, what's a mutual fund? It's a collective pool of investment that is used to buy securities. The value of the mutual fund depends on the performance of the securities. Okay. So, what happens is, as a mutual fund, it's a like let's say you as the whole class, there are 13 of you, or excluding me, there are 12 of you. Let's say you come together and pool your investments, and that pool of investments is used to buy the securities in the market. And the value of the mutual fund will depend on that underlying securities performance in the market. So, in a sense, as investors, you buy into a mutual fund. So, when you buy into a mutual fund, you get something called as a unit or a share of a mutual fund. Okay. Unlike your ordinary shares, when you buy mutual fund shares or a unit of a mutual fund, you don't get any voting rights per se. Okay. Is this clear or you want me to explain it more? Deepesh, some exemption is there in investing in mutual funds. Okay, but not always. It depends on what type of securities are invested or the mutual fund has invested in. We'll get to that, Deepesh. It can be individuals or it can be a company as well. Okay. Is this clear, guys, as to what is a mutual fund? Yeah. So write this down. Done. Okay. So next bit we're going to talk about as investors. Let's say if you want to buy into a mutual fund, how is the price determined of the unit? Okay. So what happens is when a mutual fund is set up, they can issue units or issue shares. We'll refer to them as units in order to avoid confusion. Okay. So the mutual fund sells units to investors. Okay. They can issue any number of units and they can issue units on a daily basis also if they want to, depending on if there's a demand and if there are investors. Okay. So price of a unit of a mutual fund is determined by something called as your NAV. Have you heard of this? Yeah. So NAV stands for net asset value, or it's also called as NAV, net asset value per share, NAVPS. Okay. So net asset value, the formula for that is the total value of the fund divided by the total number of outstanding shares. Okay. The total value of the fund divided by the total number of outstanding shares. So let's say the total value of the fund is determined by your total assets minus your total liabilities. So the total value, let's say for example, is your, let's say total assets is worth 10 million and your liabilities is 4 million. That means your NAV as of now is 6 million. Okay, and let's say the mutual fund has issued 100,000 units, or there are 100,000 units outstanding. So the price, sorry, here, price per unit now would be how much? Your NAV divided by the NAV divided by what, guys? NAV divided by what? It's mentioned on top, right? Exactly. Okay, your price per unit would be your total NAV or your NAV divided by the total number of outstanding shares, which is in this case 60. Is this clear? How the price of a unit of the mutual fund is determined? Yes or no? Okay, so write this bit down. Done. Can I move on to the next bit? Okay. Okay. Some of your famous mutual funds that exist, you might have heard of Fidelity Investments. You have something called as Vanguard Group, Oppenheimer Funds. In India, you have your ICICI Prudential, Access Mutual Fund, Aditya Birla Sun Life. Right? These are examples of some of your famous mutual funds that exist in the market. Okay. You want to write these examples now? Or can I move on? Okay. So next we're going to discuss the types of mutual funds. So I can give you a clue based on the financial products that exist in the market. There are certain types of mutual funds. Can you guess what they are? Closed-ended, open-ended. You're not incorrect. That is a type of investment actually. You can do an open-ended investment in a mutual fund or a closed-ended investment. We'll talk about that, Anand. Uh, Growth, dividend, differences. That's the scheme. Yes, we'll discuss that. That open-ended and closed-ended scheme. Anyone else? Financial. Financial debt hybrid. Yes, now we're getting somewhere. Okay. So equity debt. Yes. So as mentioned, these are some of your most predominant types of mutual fund that exist. You have something called as equity funds. So as the name suggests, the pool of investment is invested in which market? Equities, which is what, in other words? Shares, exactly, which is your shares. So this fund primarily aims to invest in either large cap, mid cap, or small cap companies. What does this mean? Large cap, mid cap, small cap? Exactly, market capitalization. So what is market capitalization, Saurabh? Share price into outstanding stocks. Total number of outstanding shares into share price. Outstanding shares into market. Either one word is missing in each of your definitions, right? The market capitalization is always going to be the total number of outstanding shares into current market price. Shreya got it right now. Okay, is that clear? Right? So the aim of this fund is aggressive growth, meaning they're looking for high returns. So the risk also will be high. Is everyone clear with what's an equity fund? Okay. Then the next obvious one we have is your fixed income funds. Primarily geared towards investing into fixed income products like your bonds. Okay. Here the aim is to get a set rate of return. Okay. Which is safer to invest in, bonds or shares? Bonds, bonds, yes, bonds, 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 yes. Okay. Next type you have is your index funds. So what happens is the pool of investment is invested in stock indexes. So they don't invest in, let's say, shares of a certain company. They would invest on a performance of a stock index. Like some of your examples are your Standard and Poor 500, Dow Jones. Can you give me stock indexes that are there in the world? Nasdaq is an exchange. Nifty, yes. FTSE 100, yes. Sensex, yes. Dow Jones, yes. Right? So these are all your stock indexes. All right. Next type of mutual fund that can exist is called as your money market funds. Okay. They, as the name suggests, it invests in money market instruments. So give me some name of some money market instruments. Commercial papers, yes, CDs, certificate of deposits, treasury bills, brilliant. What else is that? Repos, yes. Okay. So in this though, primarily Deepesh, they won't consider repos because your repos are bilateral agreements, right? It cannot be transferred to anyone else. Okay. But yes, this type of fund would invest primarily in your treasury bills, certificate of deposits, and your commercial papers. Okay. Then you have your exchange traded funds. Now here, unlike your index fund, in your exchange traded fund, there's a certain set securities that the mutual fund tracks the performance on a particular index. So let's say, for example, pharmaceutical companies. So it will be a list of pharmaceutical companies performance tracked on, let's say, the Sensex that the fund would invest in. Is this clear or you want me to explain it more? So, no, as in it's not clear, or no, you don't need me to explain. Okay. So, let's say if again, as a class, collectively, you guys were a mutual fund and you decide to set up as an exchange traded mutual fund, meaning now you decide you guys want to invest in the pharmaceutical industry. So what you do is, let's say on Sensex, whichever pharmaceutical company is listed, you will invest in the performance of that particular, what do you say, track of securities, which is pharmaceuticals. Does that make sense now? Versus you investing in the entire performance of the index. Now we are only on particular sector you are investing in. Does it make sense now? Okay. And then you have your balanced funds, which will be a mixture of your equity, fixed income, your money market, commodities, etc. Okay, so these are the types of mutual funds that are there or that can be set up. So write this down. Done. Okay. So next we're going to talk about, obviously, as an investor, when you invest in a mutual fund, it's not for free, right? There will be certain charges associated to that. Okay. So we're next going to talk about the charges. Okay. So the first one is your expense ratio, which is nothing but the annual operating fees for the mutual fund. Okay. So a certain percentage is taken from the investor as your operating fees, or in other words, it's also your expense ratio. Okay. So your annual operating fee makes up your advisory fee or management fee plus the administrative cost. What is administrative cost? What is administrative cost, guys? Guys, can you hear me? Because either you can't hear me, or day to day expenses, overheads, what else? Rental expenses. What sort of rental expenses? Saurabh? Saurav got it right. So there's registration costs, maintenance, etc. Also, let's say, remember I said you buy into a unit of a mutual fund, right? But the unit is made up of underlying shares. So registering those shares in your name, that's an administrative cost. Okay. So are we clear with what is expense ratio? Okay. The next is your shareholders' fees. Okay. It is the sales charge, commissions, or redemption fees paid directly by the investors when they are buying or selling units in the mutual fund. So, when you're buying into the mutual fund, it's also referred to as a front end load fees. If you're selling your units in the mutual fund, it's called as the back end load fees. These are certain terminologies that are used. Okay. So the type of fees in mutual funds you have is your expense ratio that makes up your annual operating fees, which is your advisory or management fee plus administrative cost, plus the shareholders fees. Is this clear? Okay, so write this bit down before we go on to the advantage and disadvantage of investing in a mutual fund, and then we'll talk about the structure of a mutual fund. turn. Okay. So, what are the advantage of investing in a mutual fund? What's the advantage of investing in a mutual fund? Capital is safe, professionally managed, okay, diversification, risk reduction, okay, can invest even if you have lesser knowledge about the market, correct, right? So when you look at it, the advantages is liquidity, meaning you can, what is the meaning of liquidity, by the way? Yes, or you can easily convert to cash. Diversification, meaning you don't have to invest in one particular product, you can invest in multiple products. Agreed? Yeah. Minimum investment required. Yes or no? Unlike if you want to, let's say, invest in shares, you might have to put the entire investment up by yourself. But now, because you're investing in a mutual fund, what is happening? It's a collective pool of investment. So you have a minimum investment. Also, your risk is reduced or is it increased? Is the risk reduced or increased if you're investing in a mutual fund? Reduced, exactly. Okay. Also, it is professionally managed, and you have variety of products that you can invest in based on how the mutual fund is set up. So you can either invest in an equity fund or a fixed income fund or an exchange traded fund, or if you want a mixture of all, you can go for a balanced fund, right? So that are some of the advantages of investing in a mutual fund. What can be the disadvantage? You might have some high cost like your operating fees, administrative costs, etc. That all is added. Okay. It could be a cash drag in a sense that a large pool of money every day people are putting in money and withdrawing money. So what could happen is the value of the fund can go up and down on a daily basis. Yes or no? Yeah. So that could be a disadvantage. Fluctuating returns, because depending on the product again, if you have invested in a fixed income fund, that means your returns are fixed. But if you're investing in like an equity fund, what could happen? Your returns could be fluctuating based on the market performance. Yes or no? Yeah. So write down what is the advantage and disadvantage of investing in a mutual fund. Sure. High costs in a sense, Deepesh. So remember here we talked about mutual fund fees. So the operating fees, what the advisory fee or management fee might be high. Administrative cost may be high. Sometimes when you're buying into the fund, the fees might be high. Fees meaning like how fees you pay in college, no? For a certain service that I provide you, I'll charge you fees. Like that. Got it? Fees in a sense, I'm providing a service and for that I charge you money. That is the fees. Is that clear now? Okay. So write down what is advantage and disadvantage of investing in a mutual fund? Cash drag meaning, let's say on a daily basis people are investing in the fund and people are removing their money from the fund. So unlike your this thing, you can withdraw money from your mutual fund account if you need money. Okay. So when people withdraw money, add money, the value of the fund can go up and down. That's why when I was explaining Deepesh, I said this will be more for your equity funds and your other type of funds. Your fixed income funds, the return has supposed to be fixed, right? Done writing, guys. Can I move to the next topic? Okay. So the next bit is the structure of the mutual fund. So this is the important bit to understand how your mutual fund is actually formed. Okay. So any guesses as who all might be involved in a structure of a mutual fund, like how it is formed? You might have got a clue there because I scrolled slightly up and you might have seen the first person involved. Yes, you have custodian, correct, Saurav? You have registrar, yes. It's like Saurav knows every. Trustees, sponsors, brilliant, AMCs, correct? Okay. So, we'll go line by line. Okay. So the first person who is required to form a mutual fund is referred to as a sponsor. Now the sponsor is the one who makes the application for registration of the mutual fund and is the one who at least contributes 40% of the capital. So for example, let's say if a person wants to form a mutual fund collectively worth, let's say, 1 million. So a sponsor gives 40% of that capital. So 40% of 1 million will become how much? The yeah, 400,000. So $400,000 is what the sponsor will put into the fund. Is everyone clear with who's a sponsor? Okay. From there, the sponsor also forms a trust or appoints a board of trustees. Okay, I'll repeat what's a sponsor. A sponsor is a person who makes the application to register the mutual fund, meaning he is the person who wants to form the mutual fund. Okay, and he also contributes 40% of the capital that will go into the formation of that mutual fund. So let's say on a whole, if he's looking to set up a mutual fund that's collectively worth, let's say, 1 million, then 40% of 1 million is 400,000 is what is the sponsor, or what the sponsor will invest or put up. Okay. From there, the sponsor appoints a trustee or a board of trustees. So BOT is short form of a board of trustees. Okay. The work of the trustees is to appoint an asset management company or a fund manager, and also the board of trustees are responsible to protect the fund, meaning protect the investors from any misuse of their money that they put into the fund. Is this clear? Yeah. Then, as the as said, this board of trustees hire the next person, which is called as the asset management company, or a fund manager who belongs to the asset management company. Okay. Now, asset management company can be an individual like a fund manager, or it can be a company that is set up. Okay. The work of the asset management company is they invest the pooled funds collected from the clients into a variety of securities and assets, like the ones that we mentioned earlier, like equities or fixed income or money market, etc. Is this clear? What's an AMC? Right? Some of your biggest AMCs or asset management companies are BlackRock, JP Morgan Asset Management Company, Goldman Sachs Asset Management Company, your Pacific Investment Management Company, or for short, it's called as PIMCO. Okay. The next person involved is your custodian. He is also appointed by the board of trustees. Now, custodian legally and as per regulations have to be appointed. Why? Because they are the ones who safeguard the assets and securities. Additionally, they help in clearing and settlements of the trades. Is this clear? Okay. Next, what happens is once all of these guys come together and form this thing, your asset management company or your fund manager is the one who creates schemes. Schemes like, let's say, equity scheme or fixed income scheme, or based on your investment, what will be your return, etc. Various types of schemes can be created, and then those are sold to investors. Okay. Then you have your RTAs, your registrar and transfer agents. These are institutions that maintain the detailed records of the mutual fund investors, meaning how much that investor invested initially, what is the type of scheme they have invested in, what is their return. Let's say if that investor has redeemed some units, has the redemption taken place, have we paid the money out to that person, or if an investor is buying into the fund or into the scheme, have they paid the initial investment, etc. Basically, they're sort of like the bookkeepers. Is that clear? So some of your examples is CAVI, CAMS. These are your registrars and transfer agents. Okay, and lastly, the most important bit, you require investors, people who invest in the mutual fund. So that's the structure of a mutual fund. Is that clear to everyone? Yes or no? Okay, then. So write this down. Done. Okay. Okay. So your schemes can be set up in two ways. You have something called as an open-ended scheme, meaning at any point an investor can buy into the scheme or he can sell the scheme. Okay. And then you have a closed-ended scheme, meaning once you've invested in the closed-ended scheme, only after its maturity you can exit that scheme. Okay, this was the question I think earlier someone asked about, someone mentioned open-ended and closed-ended. Okay, so those are the types of schemes. When a AMC or a fund manager sets up a scheme, he can set it up as an open-ended scheme or as a closed-ended scheme. If he sets it up as an open-ended scheme, meaning the investor can buy the scheme and then sell the scheme at any point of time. If he sets it up as a closed-ended scheme, that means once you buy into the scheme, you cannot sell it until and unless it matures. Okay, so write this bit down as well, and then we'll move on to hedge funds. Done. Okay, so Next is hedge funds. What are hedge funds? Or what's the difference between a hedge fund and a mutual fund? Hedge funds are privately placed by AMC to large corporations or HNIs, and pooled funds from this is invested in riskier products like derivative short selling. Minimum requirement to get into the hedge fund is very high. All correct points. Mostly institutional clients. Yes. Good point. What else? Okay. So the main difference, like Saurav and Annette pointed, uh, is your mutual fund is more of public, whereas your hedge funds is more as private, and usually the clients for mutual funds can be your retail investors, whereas when it comes to hedge funds, usually the clients are institutions, corporations, or it could be HNIs. What are HNIs, by the way? High net worth individuals, correct. High net worth individuals, meaning people who have lots and lots of money. Okay. And unlike your mutual funds, which is highly regulated, your hedge funds are also regulated, but they're not as highly regulated as your mutual funds. So, to give you an example, you have seen adverts for mutual funds on TV, correct? Yeah. And what is the disclaimer that they put in the end? Someone wants to unmute and tell me, or if you can type that fast, I can type it on the chat. Was that disclaimer that you hear at end of every mutual fund advert that you see? Yeah, mutual funds are subject to market risk. Please do what? Please read the offer document carefully. Exactly. Now, quick question. Have you ever seen an advert for a hedge fund? No, never, right? You've never seen an advert for a hedge fund. Yes, as per regulations, not it's not that they're not allowed to advertise. They can advertise, but not like such public forums. They cannot advertise. Okay. So some of your key differentiators are the pool of investments, obviously, the type of clients, right? Also, the types of investments that mutual fund does versus the types of investment that your hedge fund does. Okay. So again, hedge fund is managed pool of funds that uses different strategies to invest. A hedge fund is usually set up as a limited partnership company. That means there has to be one limited partner. So, what is a limited partner? A limited partner is a person who's not involved in the day to day management of the business. I wouldn't call him as a silent partner or anything like that. He is a partner, but he is not involved in the day to day running of the fund. Is that clear? Okay. So the pool of investments is usually from investors whose net worth is greater than $1 million, excluding their primary residency, meaning excluding their primary, because when you have rich people, they have usually tend to have more than one house. Agreed or not? Yeah. So excluding their private residence, other than that, what all investment or assets they have, that net worth should be greater than 1 million. Then that person is considered to be a high net worth individual. Okay. Or if it is two people, then the joint income per annum has to be more than $300,000. Okay, to be classified as a high net worth individual. Okay, are we clear with these definitions or the brief of what is a hedge fund? So write all of this down before we go on to structures, like how we learned about structure of mutual fund. We'll learn about what is the structure of a hedge fund. Yes, Saurabh. So Saurabh pointed out that one of the key difference in mutual fund and hedge fund is the presence of large incentive fees for the hedge fund manager. So they actually charge a percentage of something called as a performance fees. So the fees are somewhat the same. You have your expense fees, you have your what you say, uh, administrative cost, etc., your front end fees, your back end fees, and all of that stuff. And then, usually in a hedge fund, what they do is based on the performance of the fund, they charge a certain fee to the investors, which is called as a performance fee. So, higher the performance, then higher the fee, or there's a certain percentage they'll charge on that. Can I move on to the structure of the hedge fund? Okay. So today's class is not that lengthy. So I think we might wind up by 3, but then we can use the remaining half hour for any doubt clearance. Okay. So the first person that you require is someone called as the investment or portfolio manager. Okay. Now this person sort of acts like your how you have your fund manager or AMC in your mutual fund structure, right? So similarly, this is who we have in your hedge fund structure. So he is the person who determines the strategies and makes the investment decision, manages the portfolio risk. Also, in he is invested in the fund and compensated via management fee or performance fee. Okay, so you have management fee and performance fee for a hedge fund. Okay, now here's the catch: he will only get that performance fee if the fund makes money above a preset benchmark. So to explain this particular line, let's say there's a hedge fund that is formed, and the investment or the portfolio manager says, I will guarantee at least a 10% what do you say, growth in the fund. Okay, so we give him the invested, or we give him the pool of money. He's saying, on your pool of money which I'll take, I will invest it in the market, and I will guarantee at least, let's say, a 10% return or 10% increase. With me so far? Is everyone with me so far? Yeah. Now, let's say he's taken the money, he's invested it in the market, but he only manages to make a 5% increase on the investment. So now he doesn't get his performance fee, because the preset benchmark he set is, let's say, 10%, but he couldn't touch that 10%. He only managed to reach half of it. So now he doesn't get his performance fee. Is that clear? Okay. Now, the investment manager or portfolio manager can be an employee of the hedge fund, or he can be a part of an asset management company. Okay. Are we clear with what's a portfolio manager or investment manager? Yeah. So write this down before we get on to the next person, who is prime brokers. Done? Okay. So next we have is prime brokers. Okay. So prime brokers provide services that enable hedge funds to borrow cash and securities for investments. Um, when you guys did securitization in fixed income class, and after you did, let's say, credit default swap, did you watch that crisis of credit video, that green color video? Yeah. No, most of you say no. That's bad. You should have watched it. Okay. In if whoever has watched it, the first few minutes of that video talks about a certain concept. What is that concept? Do you remember? Give me a second. I'll see if I can pull up that video and we'll watch that just first 2-3 minutes of that video. Okay, hang on a second. Can you see the screen? Yeah, okay. I'm just going to play. Just let me know if you can hear the audio, okay? Can you hear the audio? Oh, strange. Okay. So I'll play that part. Let's see if you guys can understand. Let me see if I can put the, okay. Let's see if this works. Captions. Okay. So did you understand the concept of leverage here that they mentioned in the video? Yeah. So this is what is meant by here. Provides the hedge fund an ability to borrow cash. So these hedge funds can use the concept of leverage and they can invest in the market. Is this clear to you guys? So do watch that video. Wasn't it mentioned that you need to watch it? Guys, wasn't it mentioned that you need to watch this video, let's say after your fixed income, after the securitization bit, or after you've covered credit default swap? It's not mentioned. It was conflicting answers. Right. So this is the video, crisis of credit. It's a green color video around 12 minutes long. Please watch it. Well, there are two batches mixed in this class or what? Delhi and Bangalore, is it? Okay. Okay. So if you haven't watched the video, do watch it. It's a very interesting video that explains your 2008 crisis. Okay, right? But are we clear with what is that first line? Provide services to enable hedge fund to borrow cash and securities for investments. Okay. Then it helps in clearing and settlement of transactions. Provides custodial services like a custodian bank. Okay. And research capabilities. What is research capabilities? Any idea? It's in the word itself. Research capabilities meaning it will provide information based on markets. If you want to know about certain markets, you can ask the prime broker to provide that information. Like, let's say if you want to invest in the aviation industry, so you can reach out to a prime broker and tell them to give you a report on what's the latest trend in the aviation industry, which are good public listed aviation companies that you can invest in, etc., etc. Okay. So some of your examples for prime brokers are Credit Suisse, Morgan Stanley, UBS, JP Morgan Chase. Now, understand these guys are a subsection of your each of these banks. On the whole, these guys are called as investment banks. So prime brokerage is a service that they provide. Is that clear? Did everyone understand this point? Okay. So write down what's a prime broker. Sure, Deepesh. So, prime brokers, they are the ones who provide or help the hedge fund borrow cash or securities for investments. So, remember, you guys did stock borrow lending in the last class, right? You said that stock borrow lending was covered, right? So, hedge fund might borrow securities for investments, okay, because they're into short selling as well. What is short selling, by the way? What is short selling? Not enough shares to sell. So basically made a deal to sell but doesn't have enough shares to sell at the point they have made the deal. With the intention what? By the time they have to settle the deal, they'll have the shares. Okay. So your prime brokers help your hedge funds to borrow cash for leveraging or to borrow securities for investments. They help in settlements of the trades. They provide custodial services like safekeeping, asset servicing, etc. Plus, they provide market research on particular industries if required by the hedge fund. Okay. Some of your examples are your Credit Suisse has a prime brokerage section, Morgan Stanley has a prime brokerage section, UBS, JP Morgan Chase. Now, these all are investment banks, so prime brokerage is a division within them. Prime brokers, they help mostly hedge funds, not mutual funds. For mutual funds, you have your custodian, but custodian does may or may not provide research capabilities, and they usually don't help to borrow cash and all, unlike your prime brokers who provide the service to hedge funds. Okay, finish writing, guys. Can I move on to the next one? Guys, I can move on. Okay, so next you have executing broker. So these are the guys who are responsible for completion and processing of an order. Meaning, let's say the hedge fund says it wants to buy 100,000 shares of Facebook. So it will give this order to the uh, investment manager or portfolio manager, who will then pass it on to the executing broker. Like, they'll find a broker who will get that deal for them, and then that broker will be responsible to execute the order either in your order driven market or your quote driven market, right? And ensuring that the trade settles. Okay, so sometimes your GS acts as broker, your State Street also acts as brokers, or your Deutsche Bank, your TD Bank, most of your, even Morgan Stanley to an extent. Okay, they act as brokers as well. Okay, pretty simple, right? Then you have your auditors. As per regulations, every hedge fund should have a auditor. They are required to verify the financial statements of the hedge fund, and on a yearly basis, these reports are submitted to the regulators. Why? Why? For validating, partially correct. Also, for what reason? Verification of what? Education. Verification of documents. So basically, this audit or these financial statements and all are submitted by the auditors to the regulators, is to ensure that the hedge fund is operating within the stipulated regulations. There is no misuse of the funds, and there is no, what you say, investments done in bad markets, or the funds are not black money, which you covered in your AML KYC class, right? It could be a form of placing. Yes or no? Yeah. So that's why you require auditors. So write down executing broker and auditors, and then we'll see what are the three main strategies used by hedge funds when they invest, or the way they are set up. Done? Okay. So I'm going to move on to the three main strategies followed by the hedge funds. So first one, the hedge fund can set up as a single fund structure. So the sponsor or the asset management company. So this structure first came up in the US market. Okay, so that's why it's referred in terms of this thing. So the sponsor or the asset management company can either be a US based company or an offshore based company. Okay, so what happens is the sponsor can be either a US citizen or a non US citizen. Okay, it's a single fund structure. It would invest in a single market or in a single type of product, like let's say only equities, or let's say only we have heard of junk rated companies, right? What are junk rated companies? What are junk rated companies, folks? Risky, exactly. Low ratings, meaning chances of these people to repay back debt or the chances of surviving in the market is little less or low. Okay, anything rated below triple B is deemed as junk rated. Okay, in terms of rating. Okay, so single fund structure, one, the sponsor can either be of the same country or can be from another country who's set up the hedge fund. Okay, additionally, they in a single fund structure they invest only in a certain type of product. Is that clear? Is this clear to everyone? Yes, no, maybe. Yeah, write this down before we go on to side by side. Someone's mic is on. Can you mute it, please? Hemraj, your mic is on. Can you mute it, please? Yeah, Deepesh, offshore meaning not from the same country, from another country. Done writing, folks? Yep. The next one is side by side. So side by side is you run one like you have invested in one type of product in the domestic market. Okay, and you have the same setup in an offshore market as well. Okay, and you run it at the same, meaning what strategies you deploy in the domestic market, the same strategies you will deploy in the offshore market as well. So to put it in an example, let's say in the US market, I've set up equity hedge fund, meaning I'm going to invest only in equities. And to be more specific, let's say I'm going to invest in small cap companies but have a high growth rate. Okay, so in essence, you could say these are sort of junk rated companies. Now, similarly, I'll set up another fund in the offshore market, again, an equity hedge fund, and I'm going to invest again in small cap junk rated companies. Is this clear? So that's called as a side by side structure. Is this clear, guys? Sure. So let's say in the US market, I set up an equity hedge fund that hedge fund is investing primarily in junk rated companies. The similar setup, I have a setup in, let's say, in the European market, and I'm investing in the European markets, whichever is a junk rated company. So two funds set up side by side, but the strategies that are deployed is the same. Got it? Okay. So write down side by side. Okay. And last one, we have your master feeder structure, right? So to put it in a very simple way, master feeder is nothing but you have one main fund that is set up, and then you have multiple other funds that invest in certain products. That's or invest in only one type of market as a hedge fund, and they're like a sub fund to this master fund. So all the investments that they make and all the returns that they get spread into the master fund. So I'm going to repeat it again. So master feeder structure is nothing but you have a main fund, and you have other funds that are again hedge funds itself, but they, let's say, invest in certain markets. Like, let's say maybe one invests in the aviation industry, one invests in the agriculture industry, let's say one invests in the arms industry, etc. So now all of these three, they feed into the master fund. So any profits that they make and everything, it all goes into the master fund. Is this clear? Is this clear for everyone? Okay. This is commonly used to minimize tax impact. So your uh, feeding fund or the smaller funds, it doesn't necessarily have to be in the same domestic this thing. It can be set up offshore, like in tax haven countries as well. Can you name some tax haven countries? Have you heard of this term, tax haven countries? You must have heard it in your email KYC class. Yes, British Virgin Islands. Thanks, Saurabh. Panama. Very good. Right? Coast of Ivory. These are all examples of tax haven countries, meaning either no tax or less tax. Okay. So with that, your asset management class concludes. Cayman Islands, brilliant, Saurabh. That's a very popular place where they set up a this thing. And in fact, if you have investors who have invested in the Cayman Islands, or part of their funds is from the Cayman Islands, there will be a strict scrutiny done on those funds. And um, as per your AML KYC process, do you think in customer due diligence they'll be tagged as a simple, standard, or enhanced? Did you understand my question? Okay, so Saurav said one of the examples for tax haven countries is your Cayman Islands. So I said, let's say if you were an investment bank and you had an investor who was from the Cayman Islands, or he set up his fund in Cayman Islands. Now, when you're doing your client onboarding and you're doing your email KYC checks, or rather your KYC checks. So in KYC, what are the three stages that you have? What's the first stage? No, no. The first stage in KYC, not in this customer due diligence. What's the first stage in KYC? AML KYC was covered, right? Yes, customer identification. Thanks, Anurag. What's the next stage? Customer acceptance. Thanks, Shreya. And what's the third stage? Which stands for what? What due diligence, Aurav? Customer due diligence. Now, when you're doing your customer due diligence, this investor from the Cayman Islands, his tagging will be a simple, standard, or enhanced. That was my question. Why? Why will be tagged as enhanced? Okay, one HNI. Is that the only reason? FI, I didn't understand. What do you mean? Thanks, Saurabh. So to put it in a simple listing, the guy is set up in Panama, right? His this thing. So that's a tax haven country. So regardless of this thing, he has to be tagged as an enhanced due diligence check. Okay, all right. So that's it for your asset management class. So tomorrow again we have a class at 1:30. I'll be again conducting it. It's your overall refresher for your level 2. So in level 2, what all topics are covered was your exchange TLC, OTC TLC, your settlements, reconciliations, custodians, RDM, AML KYC, stock borrow lending, corporate actions, and this class. Correct? Yeah. So, any doubts on these topics? Please write them down. So tomorrow, as soon as we start the class, we'll clear the doubts. Is that okay, guys? Okay. So this class video, I'll get it converted, and hopefully by tomorrow evening, it should be available uh, on the link. Okay, I'll send it to Sadaf, and Sadaf will upload it. Ganesh, I just explained what the refresher would be, right? Refresher would be a doubt clearing session for your level 2 on what all topics are covered in level 2. After that, I think you should have one more domain class on regulatory risk and environment, if I'm not mistaken. And you should have one more overall refresher, meaning from all the way from your level 1 to level this thing. Today's class, I'll send Jacob the recording. That's what I was talking about. And after that, I think you should have your test and your final marks. Okay. Saurav, I didn't get your question. Ganesh, you'll have to check with your placement coordinator because I just freelance with the Marticus. I'm not a full time trainer with the Marticus. Okay. What I do know though, it's conditional for you to clear your mocks in order to get interviews. Saurabh, I didn't get that was covered. What was covered? Was it a question or a statement that you gave? Oh, okay, it has been covered. All right. Then I think this is your last domain class then. So for both batches, it's covered. Bangalore and Delhi, regulatory risk and this thing. Okay. Okay, fine. Then today is your last this thing domain class. Then tomorrow will be your overall refresh. Okay, so then it will be from anything from level 1 all the way till what was till the end. Okay. All right, then. If you guys don't have any questions, we still have 10 minutes. So if you have any questions, you can ask me or we can wind up for today. Attendance for Bangalore batch, I'll be marking it. For Delhi batch, I think one of the Delhi trainers must have taken me this thing, Ganesh, because I won't have access to your batch to mark the attendance unless you're Bangalore batch, that is. So pension funds, it's sort the in UTI is sort of they function same as like a mutual fund. This slight difference is your pension fund is a part of like how we have provident fund, no, here part of your salary gets cut and put into PF and then it is invested and then you can withdraw. In other or in foreign countries they call it as pension funds, and they are also highly regulated like your mutual funds. Okay, any other questions? Yes, no, maybe. No. Okay, if no more questions then we can wind off for today. So enjoy the rest of your Saturday and we'll meet up tomorrow. Okay, thanks guys.